Example 11.3. MKZ Airlines wants to raise $100 in equity. It has two options: to value cost of equity, RE, use the Gordon's model, or use the CAPM model, capital asset pricing model. Underwriter CC figures that MKZ must be conservative and accept the higher cost of equity for valuation purposes. The 5-year annual average return on risk-free rate, that is a rate on 3-month Treasury bill as of the last 5 years, is 2.58%. Beta for MKZ Airlines is 1.2%. The average annual return on the S&P 500 index in the past 5 years is 9.03%. And MKZ Airlines is expected to pay a dividend of $3, which is expected to grow by 2.5% per year. So the dividend growth rate is 2.5%. Then its current share price is $35. What's the cost of equity as determined by each case, and which cost is recommended by the underwriter should MKZ choose? Going to Excel. Already entered these values in this. So risk-free rate is 2.58, rate of return from the market is 9.03, beta is 1.2. So we can just simply find out the rate of return from the stock as RF plus beta times beta is M4 times RM minus RF. That's 10.32%. Just comparing it down here, 10.32%. Okay, now the dividend discount model says it's D1 divided by P0 plus G, 11.07%. Now the number of shares, well, we need to make an issue of $100. So $100 divided by per share cost is 35, so approximately 2.85. But since we cannot issue partial shares, we have to issue 3 shares. So 3, the size is 3, and then times the per unit share is $35. So 105 is the value of this issue. Now we'll be issuing $105 in stock, and the cost that will be considered as conservative as cost of equity is 11.0714%. And that's example 11.3. Thank you for listening.